In this paper, we examine the current state of housing in Sri Lanka, the reasons for the gap between the demand and supply of housing units. We look at anti-competitive practices in the construction industry and how it impacts the affordability of housing. And finally, we set out some recommendations to address market and government failure in this sector. So just to give you a brief snapshot of what the findings from this report were, basically we found that there was a nexus between trade policy and anti-competitive practices in the construction industry. And these trade practices or these anti-competitive practices have affected consumers through higher prices of construction materials, lack of availability of construction inputs, and by limiting choice of consumers. The CAA agency for regulating competitive, and also what we found was that the CAA, which is the agency for regulating anti-competitive practices, suffers from a lack of independence and capacity in terms of taking action against these anti-competitive practices. And so we looked at, how can this agency be strengthened or what needs to strengthen this agency. And then we look at how we can actually phase out, the need to really phase out some of these restrictive trade practices and improve competition policy. So why is this an important issue to address? We already said that there is a housing shortage, and we did an analysis using the data, census data. There is a housing and population census for 2012. We estimated the gap for housing. Unfortunately, we don't have a more recent data, or we don't have more recent data, as the 2022 housing and population census is yet to be conducted. And based on our estimate, the housing gap in Sri Lanka has expanded by about over 200% between 2012 and 2022. And the highest gaps really are in the urban areas, in Colombo and Gampa, etc., which have the largest shortfall. But if you look at the housing stock that we're talking about from this census, we are actually not looking at the quality of housing. So there was another survey done by the NHDA in 2016, which actually captures the quality of housing. And if you incorporate that, the gap between the demand and supply is even greater. So that is the crux of the matter, really. So because of this housing shortage, if you look at in terms of an international comparison of housing, the price of housing in Colombo versus other major cities in the region, using this particular index that they use, it's a price to income ratio, which is basically a measure for apartment affordability. So it's apartments, look at apartments, where a lower ratio indicates better affordability, and it's typically calculated as a ratio of median apartment prices to median family disposable income, expressed as years of income. You can see that Colombo has one of the highest price to income ratios in the region. It's even higher than Beijing. But there are certain limitations in this, because we are talking about affordable housing and this looks at apartments. So what we did was we actually did our own calculation of a housing affordability index, which takes into account lifetime earnings of households and the price of a standard house. And here we want to acknowledge the assistance of Professor Tilak Abesinghe, who very generously shared the methodology he has developed to do this with us. So based on this, this is kind of what we looked at. This is the Housing Affordability Index, where we look at the lifetime income of households for each birth cohort, and we look at a time series of prices, of housing prices. And here again, there were huge limitations because it's very difficult to find housing prices in Colombo, or in Sri Lanka actually, so the publicly available data. So we had to go with some bit outdated data in a sense from the NHDA and also from one of the from one of these companies that put out this data. So what this housing affordability index does actually, it implies that, okay, if your housing affordability index is 1, it means your lifetime earnings is sufficient to purchase a house. But of course, then there is no extra income to do anything else to maintain your living standards. So hence, this household affordability index has to be greater than 1. And the cutoff point that is used to calculate this takes into account, what banks really use to lend, or the rule of thumb that they use to lend for housing loans, where they say, okay, you have to have like at least 35%, that they give up to 35% of your income. So we use that same threshold, and the housing affordability index threshold that we calculate was something close to 3. So keep that in mind when you look at the next graph. So when we did that calculation, so based on these calculations, what we found was it's only households. So using this we did also, sorry, the household incomes we took from the household income and expenditure surveys over time, and that's how we tracked lifetime income. So what we found was only households above the 70th percentile can afford a 500 square foot house, even accounting for your lifetime income. And if you were trying to build a 1,000 square foot house, only those households above the 75th percentile, income percentile, were able to afford a house, a 1,000 square foot house. So to understand why housing costs are so high in Sri Lanka, we look more closer at the key inputs into the construction industry. So when we look at that, we analyzed 3 major inputs really. We looked at cement, tile, and aluminum. We didn't look at steel. Steel is a big component, but we were told that it didn't go into exactly affordable housing, but I just had a chat, and I was told that if it's a medium-rise buildings, actually this would be important, so maybe we can include that in our analysis. So in all 3 input markets, what we find is that domestic manufacturers account for a higher market share in the domestic market, but that this domestic manufacturing segment has a very oligopolistic nature. So there are either 2 or 3 or 4 players in the market. There are few large players, and they dominate the market. Another key feature is that sometimes between these domestic manufacturers, there are players that hold significant market share in other input markets. And these concentrated market shares become more concerning when we analyze this ownership structure. So we just looked at some of this ownership structure, and here what we find is, if you look at the different nodes, if you look at all the nodes in orange, you'll find they refer to all the local tile manufacturers. The ones in purple are the aluminum manufacturers, and the ones in maroon are the holding companies. And what we see here is a significant cross-ownership. Out of the 4 tile manufacturers, 1 holding company owns the largest 3. On top of that, this ownership structure has led to backward and forward integration in the value chain. So they own the mortar and grout companies and packaging companies. And in the aluminum sector, the 2 holding companies own the largest 2 companies operating in the market. So analyzing the ownership of these 2 holding companies, we see that a single entity or firm has a majority stake in these different industries. And this has led to certain anti-competitive practices. So what were our major findings really? So based on this market share and ownership structure, we find that there's little competition among domestic manufacturers. So any competition that can come has to come from imports. However, what we found when we analyzed trade data, we found that the trade policies have resulted in these firms actually being protected from imports through high tariffs and para-tariffs. For example, if you take an example of the tile industry, the effective protection rate, or the effective tariff rate, not the protection rate, effective tariff rate on tiles exceeds something like the 83%. And out of that, 50% of it comes from the cess. because the domestic manufacturers only pay the VAT. Right? So at that, when we did the study, it was 8%. Now, of course, it has gone up to 15, and it go up at 18. But still, at that time, it was only 8%. So you can see the huge disparities. Again, cement, in the area of cement, importers are levied a cess, but local producers are exempt. The other thing we found was there are these various ad hoc policy changes that have happened, particularly on the trade sector. One is the sweeping bans on imports. Of course, that was in response to the COVID pandemic. But it basically drove out importers almost overnight. And several changes to and there have been several changes to these banned products, which has, had created distortions in the market. The other one, of course, also there have been various industrial protection that has been given to these sectors. So there's an Industrial Protection Act, which was enacted in 1949, I think, which gave protection to the ceramic industry. Similarly, in October 2013, the government introduced a policy limiting cement, or one cement factory per port. And this again was to protect the domestic players. So you can see that all these really have resulted in protection to the industry. The other one is also that some of these items have been included as in a negative list in some of the FTAs that we have signed with, particularly with India and Pakistan. So all these have actually resulted in protecting the domestic industry. But then what has been the impact of these for consumers, for people who are actually trying to build a house? So from the consumer welfare point of view, what we see is that from all these market structures and industry practices and trade policies, the main impact has been on low-income earners, who are most sensitive to price changes. So look at cement first. We see that when there was a restriction on cement, this basically first, when the tariffs on cement were increased, because of the difference between the effective tariff rates between for clinker, which is for domestic manufacturing, versus for the import tariffs for importers, basically it completely wiped out the imports of bagged cement, which is what is imported. And the bagged cement that was wiped out is that of cement which is less than or equal to or less than 50 kg bags, which are the small bags, which is what is really used by households. So you can see this segment who purchase households only use this. So you can see what tariff rates or changes in tariff rates, how it impacted the price of cement. There was a sharp increase in cement prices of over 150% during that period. Secondly, if you look at tiles, we look at the tile market. So there's a huge wide range of in tiles, because they're imported from countries like China, India, which are more affordable, of course, and the high end, which are Italy and Spain. So when you had these across the board import restrictions in April 2020, again, it practically wiped out imports overnight, leading to increases in prices of more than 100%. And also what it did was, because the domestic manufacturers, tile manufacturers, did not have the capacity to scale up so quickly, they were not able to meet this demand. So by restricting it, what happened was people had to really wait months, even years, to be able to, to be able to actually access these tiles. And so there was a high prices, lack of availability, and again, your choice was limited because you had to go with whatever was available in the domestic market. And thirdly, of course, we looked at the aluminum sector, and there again, because aluminum is a substitute, affordable substitute for timber, but it has always been, but the problem is because again, the pricing issue. There again, because of the effective tariff rates, or the difference between the effective tariff rates on domestic, the raw materials are brought in for domestic manufacturing versus the imports of the finished good, again, what you see is there's a huge difference in the, there has been a huge increase in prices because quantities have fallen. Because as soon as the import tariffs were increased for the importers, you saw a massive reduction in imports, and also due to the import bans that were imposed. The volumes fell off, which increased prices. So the effective rates, the difference between the effective tariff rates on finished products versus raw materials caused this distortion in the markets. So I'm not going to dwell too much on this, on the legislation and how the Consumer Affairs Authority, which is the authority that is really responsible for ensuring that there are no anti-competitive practices, because we are going to have a whole session on this in the next session, and Malati will take you through that. So I'm going to sort of focus on the trade issue. So looking at the conclusions and our policy recommendations. So the major limitation of the study that we had was there was a lack of case data on actual anti-competitive practices in the industry. Because there have been no cases have been actually filed in this area, although anecdotal evidence seemed to suggest that there was something. Because many of the people we interviewed did allude to some of these practices. So hence, in the study, we actually relied heavily on studying the trade data and trade policy to understand these anti-competitive practices. And what we find from that is really that there is it highlights a nexus between trade policy and anti-competitive practices in the construction industry. Trade policy and other government policies have been used to protect domestic manufacturers from external competition and promote the emergence of dominant companies and other anti-competitive practices. And these policies basically have negatively affected consumers through higher prices, lack of availability of raw materials, as well as by limiting choice. And more recently, these across-the-board import restrictions, which were imposed, of course, to address this balance of payments crisis in Sri Lanka, has further exacerbated the impact of trade policies on consumers, and particularly low-income households. So the findings from this study, what it suggests is it calls for a gradual phasing out of all these trade restrictions and the avoidance of ad hoc import controls or import trade practices or import policies to address these internal and external sector imbalances, and also to greater trade openness that will prevent domestic manufacturers from abusing their market power by allowing new entrants into the market and increasing this contestability. And greater competition will also force manufacturers to become more productive while benefiting consumers through more competitive pricing. Thank you.